Welcome to the May 2025 quarterly webinar of the Brilliant Investment Committee, hosted by the Inside Network. This initiative offers independent and boutique financial advisors across Australia access to premier thinkers in the field aimed at enhancing portfolio construction. I'm James Dunn from the Inside Network, your moderator and chair for today's session. Joining me are our esteemed committee members, portfolio strategist Kev Toohey, macro outlook specialist Damien Hennessy, and independent investment expert Giselle Roux. Investment committees are essential to advice organisations making strategic decisions on how they invest client money, evaluate performance, and review and manage portfolio diversity risk. A best practice investment committee is a forum in which investment ideas, strategies, and products can be discussed and debated before they are used in client portfolios. It also introduces a broader macroeconomic and geopolitical context to inform asset allocation decisions. In short, it's the essential infrastructure that a successful advice practice needs in the modern world. As part of Insiders, its membership-based community for financial advisors and their practices, the Inside Network has been delighted to offer over the past year the Brilliant Investment Committee, BIC. It's a virtual outsourced independent investment committee that members can access. For practices that don't have such a body or want a second opinion, the BIC has brought together some of the best thinkers in the Australian investment industry to fill the role of a permanent, interactive investment committee, of which Insiders members can ask the burning questions. Mirroring the inception of a real investment community at the inaugural meeting of the BIC, Kev Toohey from Atchison, the committee's in-house asset consultant, presented a base case for economic growth and asset class performance, similar to a real investment committee's inception. Following this, Damien Hennessy from Zenith Investment Partners, the external asset allocation consultant, discussed the outlier potential macroeconomic and geopolitical events that, however unlikely, could challenge these assumptions. A notional strategic asset allocation, SAA, in the form of a notional long-term reference portfolio was presented for discussion, and the backdrop to the investment markets was assessed. The committee's external investment advisor, Giselle Roux, questioned and challenged these assumptions, offering her perspective, and the reference portfolio was subsequently adopted by committee consensus. The reference portfolio represented the committee's views about the investment environment and marketplace. In the March meeting, which was the first of the first Brilliant Investment Committee session for 2025, the committee explored several key macroeconomic themes shaping global markets. These included rising recession risks in the United States, the emergence of early tariff concerns and how these compare with previous cycles, and a deep dive into the transition between economic regimes. The team also examined which investment factors tend to outperform across different market environments, and following these discussions, the reference portfolio was adjusted accordingly. Notably, there was a significant reduction in Australian equity exposure, a higher allocation to unhedged international equities, and a greater emphasis on real assets. The committee maintained its overweight position on long-duration fixed income and further increased its overweight stance on short-duration assets. Since the March meeting, markets have remained volatile. US equities briefly entered correction territory before rebounding sharply following Liberation Day on April the 2nd. After an 11.2% correction in April, the S&P 500 benchmark at time of writing is up 1.2% year to date. Tariff uncertainty, geopolitical tensions, and shifting central bank outlooks continue to drive market sentiment. In today's session, the committee will review the portfolio's performance since March and assess whether recent positioning has added value. The discussion will include a fresh analysis of macroeconomic and geopolitical developments with a particular focus on tariffs, regime dynamics, and ongoing instability. All attendees today are encouraged to participate and pose questions to the Investment Committee members via the chatbot, which is located at the bottom of the screen. Throughout the webinar, at any time, our committee members would welcome questions. So thank you all for joining us. We look forward to the May meeting of the Brilliant Investment Committee. And to kick the committee off, it's a great pleasure to pass over to our macro outlook specialist, Damien Hennessy, who is Head of Asset Allocation at Zenith Investment Partners. In 2003, Damien co-founded Heuristic Investment Systems, offering investment strategy, economic analysis, and asset allocation advice to fund managers, industry funds, wealth managers, asset consultants, and financial planning groups. And Heuristic joined the Zenith Group in March 2021. Damien will present on the current macroeconomic and geopolitical backdrop to markets, with a particular emphasis on the policies of the relatively new US administration, the potential ramifications of those policies for the US economy, and where the Federal Reserve comes into that picture and makes its, hopefully, independent decisions. So please welcome Damien Hennessy.
Thanks very much, James, and welcome to everybody listening in. So yes, obviously it's been a very volatile and uncertain environment that has really started since the election, and obviously has intensified over the past month or so. So I just want to start off with just focusing in on the tariff policies that we've seen. So if we have a look at the first slide that just shows the move in the market and some of the key events over the period that we've just come through. So we've got it set back at the election result, the Trump election victory, and I'll just highlight a few of the events over the period. Now, the S&P 500 peaked in the mid to late February at around 6,150 or close enough to. But around about that time, or just following that, we had a series of events that really created some issues for markets. And probably one of the first ones was the so-called Zelensky ambush. And that probably highlighted to the markets that perhaps the future of NATO might be in doubt. And that set off a lot of thinking around, well, what is the role of the US going to be as being, the global policeman going forward? And we might discuss that a little bit later on. Then, of course, we had a series of threats around tariffs on the EU. And probably one of the key events during the period was the comments made at one point by Trump and indeed some others in the administration that they were prepared to cop some collateral damage from their tariff policy. And that really unnerved markets who had previously thought that there would be a Trump put and the put was not that far away and that we wouldn't see considerable downside. Well, that was clearly the wrong approach. And then with Liberation Day, the market fell down below 5,000. So that's all history. And at that point in time, it seemed like, recession risk was very high. Markets were, there was no appetite for risk. In the period since, and you can debate what caused the Trump administration to sort of back off on its tough tariff policy, I suspect the concerns around economic growth was one of them, but also concerns around the impact on the bond market was also really key at that time. And so we had a series of backdowns, which has essentially taken the tariff rate or the expected level of tariffs back up closer to what was originally thought. So in this session, I'm going to talk about what markets are currently pricing in, and I'm going to look at some of the scenarios going forward. We're also going to look at the narrative. So this sort of environment, uncertain environment, is ripe for narratives, and they can be exaggerated. Markets can run with some of those narratives, and that provides a source of volatility. We're going to also ask the question, is the US still exceptional? And then we'll touch on some of the bigger enduring themes in markets. So let's just push on. And I'll just one more slide on tariffs, and that's going to be, where are we right now on the tariff question? So the chart here just maps the US average tariff rate going back to 1820, in fact. So it's a long-term chart. At the time of Liberation Day, with the announcements made then on the reciprocal tariffs, the average tariff rate was going to be close to 30% in the US, which was the highest since the early part of the 1900s. With the backdowns that we've seen over the past few weeks, that average tariff rate now looks like something around about 12%. So 12% is still high. It was 2.5% for roughly for the last 20 to 30 years. So what does a 10% to 10 percentage point increase in the tariff rate mean for inflation? So the rule of thumb would be that it would add about 1%, 1 percentage point to US core inflation. So if inflation, our expectation was around about 2.3 prior to all the tariffs, it's now slightly above 3%. What does it mean for growth? Well, coming into this policy, US was growing around about 2.3. So a 10% increase in the tariff rate would take about 0.7 off growth. So not a disaster as it currently sits, but certainly markets had at one point thought it was going to be a lot worse. So let's have a look now at the next slide, which is looking at what markets are currently pricing in. So just on the right-hand side, we've got the S&P 500. Black line is the index level on the left-hand scale. So you can see they're now sitting up around about 59.50 or thereabouts. Briefly, in the early part of that chart, which is April, the market dived down below 5,000. Now, the coloured shaded areas are the implied probabilities that we measure or estimate that the market was factoring in at the time. And so various modelling exercises allows us to try to track what the implied probability was. So the equity market at that time in early April, we think was pricing in a 70% likelihood of recession. That's that aqua shaded area. You can see on the right-hand side of that chart now that estimated recession probability is something like 10%. So it's almost priced it out. So the market's become a lot more optimistic, and in fact, it started to even think about the purple, which is we would think could be characterized as strong productivity, AI-related boom. That, in our view, is starting to creep back into markets again. So wild swings in the market. Fed funds rate, on the other hand, is firmly on the soft landing scenario based on current pricing and pricing in only a 25% recession risk. So let's just explore some of these a little bit further on the next slide and ask ourselves the question, well, what's actually happening out there in terms of the real economic data? So the list of indicators I have there are characterized. Black is what we would call hard data, and the white is so-called soft data or survey or consumer questionnaires and surveys. So what we find at the moment is, yes, there's a number of indicators that are flashing, we've marked it green, representing recessionary type outcomes, but the majority are probably still of the blue, which is early contraction. So economy's rolling over, but it's not recessionary. And I think that's sort of where we sit at the moment. So a lot of the so-called soft data, consumer expectations, these sorts of indicators are very pessimistic. If you ask a business, what are you going to do on your capex? If you ask a consumer, how do you feel about the world? They're very pessimistic. If you actually look at what's being spent, what actual true activity is occurring, it's much less pessimistic. And that supports our view. If we go on to the following slide, it supports our view that the most likely scenario still is the second one in green, which is we put a 50% likelihood on it, and it is an environment where the average tariff rate ends up being somewhere between 10 and 15. Growth slows, sure. Inflation's a little bit higher, sure, but Fed looks through that. The Fed could cut maybe a couple of times. And as we go along the right-hand side of that chart, you'll see we've got equities up high single digits, probably a bit less than that, given the continued ramp up in prices in the past few days, but still, small positive gains from equities, but probably more importantly, a broadening out of that rally. So we've seen Europe outperforming, and we'll talk about that shortly. Japan to some extent, also looking across the various market cap segments. So that's our base case. The recession, which is that top scenario, is still a big risk, but it's as I said, not our base case. And that recession scenario is where tariffs actually do end up much higher, in that 15 to 25% band. Fed can't cut quickly enough. Margins are hit at the corporate sector level, and the equity market's down quite sharply from there. So they're the scenarios. I won't talk about the bottom two, but as they're not a high probability just at the moment. Now I want to go on and just talk now in the next couple of slides quickly about exceptionalism, or ask the question, is the US still exceptional? So two things that happen on the left-hand side. You'll see the performance of the various markets this year. So green is the US, and as we know, the US led up until about probably December. It was the best performing market by far. But from around about January onwards, we've seen other markets start to come in quite strong, and Germany in particular is out now up something like 40% over that period since the beginning of 2024. So what's happening there? Well, you've seen part of the new US administration's policy mixes to put more pressure on Europe to implement either increased defence spending and or contribute more to global demand. And Germany has responded with a fiscal package and a defence package. And together those two have helped drive up expectations of growth in Europe and Germany more specifically. So hence the strong performance of that market. At the same time, the ECB is still fairly active in cutting rates. So a much better environment. Is it sustainable? Well, the chart on the right looks at the growth in each economy since 2009. The US, along with Australia, have done about 2.4% per annum over that period. You can see there the orange part of the European bar was Europe has done a mediocre 1.2. If we add in now the expectation based on fiscal and defence spending, infrastructure spending in Europe now, that lifts to about 1.6. So the gap between sort of US growth and European growth is going to narrow, and that's what markets are starting to price in. Next slide is just continuing on this theme of US exceptionalism, and I still would have the view that you cannot ignore the strength in the innovation and the quality companies that are located in the US. And the chart on the left-hand side speaks to that. It looks at the first bar is in the shaded part of the bar is the typical range for EPS growth in the US. So yes, it's weakened. The red dot shows that it's weakened recently, but it's still pretty strong. If you compare it to the one alongside, the green bar, that's European EPS growth. So this is going back 30 years of data. So US has continued to outperform in a long-term sense in terms of earnings growth. And then the next two bars on that chart represent margins. So that margins in the US have typically been in the range of about 10 to 13%, whereas Europe probably around about 8 to 10%. So stronger profit growth, stronger margins. There are two reasons why I don't think you can say, even though we're much more positive on Europe, I don't think you can say that US stocks can't be a core part of the portfolio. And then further to that, valuations, although still stretched in the US markets, and these are the various sectors. So I'll just highlight one, which is the grey second from the end chart. That's the PE multiple on US IT sector. It was sitting at 30 times. It's now about 26 times. Still a tad expensive, but certainly has cheapened up over the last few months. All right, I'll push on now to just a couple of thoughts on the US dollar. There's a lot of talk around, is the US dollar status done, over? Is it at risk? Well, chart on the right just shows that the US dollar is very expensive, so we should expect some sort of weakness, and that's what's happening at the moment, partly because of those growth pickups in Europe that I'm talking about. Chart on the left shows that the US dominance is not going to go anywhere quickly. The US is used for almost 90% of FX trades. it's used 70% of global bond issuance. It amounts to about 60% of global or central bank currency reserves. You know, 50-60% of export invoicing. So it is a widely used currency and unlikely to change anytime soon. Now, the next one, I just want to a couple of closing comments on the domestic economy. Great news this week with an interest rate cut. I think it's probably a one of two, maybe three. I think the market's too excited about too many rate cuts. Yes, inflation's back into the range, but what we think is that the domestic economy here in Australia is actually starting to find there's green shoots coming through, let's say. So the labour market is still reasonably tight. Wages are growing at 3.5%. Inflation's back 2.5% or thereabouts. So you've got real wage growth. You've got business forward orders starting to pick up. So that the environment here in Australia we think, is starting to improve, and therefore the RBA, although cutting rates slightly, is unlikely to embark on a deep and sustained easing cycle. And I think that probably finishes that slide. So thanks very much.
Thank you, Damien. And I'll now pass over to our portfolio strategist, Kev Toohey from Atchison Consultants, to update the Brilliant Investment Committee's reference portfolio and how some of those implications flow through to that. Kev is the principal consultant at Atchison. He joined the firm in 2005. He has significant experience regarding the management of investment portfolios with a range of financial institutions, including wealth management groups, APRA-regulated super funds, not-for-profit groups, family offices, local government, and insurance companies. Kev leads the development of Atchison's in-house analytical capabilities. Kev's going to summarise the performance of the notional reference portfolio over the most recent quarter, and having gathered input from the other committee members, Kev will present the implied impact and the directional views of their positions on the portfolio's asset allocation. So welcome, Kev.
Thank you, James. And thanks, Damien. I'll try to build off what you've said. If we go to the first slide. So we've got a economic regime model that we use for our portfolio construction. And really, this helps us sort of identify where different economies are, and then that helps frame the relative decisions around country allocations or factor styles that and industry weights and those sort of things that should be considered when you're building your portfolio construction. So it really bases around trying to understand on a forward-looking basis the trends for different economies on both a growth trajectory and also inflation, and then that gives us this 4-quadrant model where we've got type 1, which is our top left, rising growth, falling inflation, rising growth, rising inflation, top right, and then below the line where you've got the growth trend softening, where the inflation is also falling, or if it's rising. That gives us these 4 quadrants. If we go to the next slide, what the analysis shows is that, generally when you're above the line on a sort of 6 to 15 month basis, it pays to be overweight equity beta when you're above that line, when you've got the forward-looking signal around growth at your back and helping the portfolio. You want to be underweight in the bottom left, and the real bearish scenario tends to be in that bottom right quadrant, where the indicators are showing both on a forward basis for growth and inflation picture are poor. So that gives us our sort of our coordinates, if you like. So if we then go to the next slide, you can imagine these 4 quadrants. What I'm showing here is the raw signal that we have for the US market, and this is taken monthly. The dots represent every month in the past sort of 60 years. So you can say that it does spread around. The red marks show the last 12 months of the US market, with the largest dot in red there being the April data point. So you can see the sort of path for the last 12 months. And so if you think back what we had 12 months ago, the US market actually was softening sort of pre-election, and there was a relative sentiment was off at that point. Then leading into the election and ultimately Trump's win, markets were off to the races, and the general signals from the economy were quite strong. That's then started to dissipate in 2025, sort of post January, to the point where the March print and now April are below that line. So what this means for the US in our model, we've gone from this type 1 top left position to bottom left, where the raw signal is saying it's challenging on a relative basis compared to where we were for US market. So that signal sort of came through in sort of mid-February in this model. So we go to the next slide. We replicate the same analysis across markets. I'm here showing the Aussie market. So I guess this sort of lines up with what Damien was saying. The Aussie market on a relative basis is still in that top left quadrant, where the growth signal is still positive. Inflation scenario is still good. We're coming off a very high level of inflation, obviously. So we'll expect some retracement to the right over the coming period, but certainly at the moment, inflation is not a concern. It's a positive signal in the portfolio at the moment. So that gives us US and Aussie. If we go to the next slide, I'm just showing here various other markets. So these are the last 12 months for each of the signals. You're saying obviously there's been the strong improvement in the outlook for China that's occurred. Europe is stayed in that type 1 scenario. UK has had a bit of a blip. So UK had been relatively poor, call it 7 months ago, had been strengthening, has come off in the last most recent print. But the one I really want to maybe point to is the Japan one, which is quite significant. So everyone got relatively excited 12 months ago with Japan, where they were going to be doing some corporate reforms. Ultimately, the growth signals petered away. Markets did very poorly. It found itself in the worst quadrant because the inflation on a relative basis for Japan was relatively high compared to what's used to in Japan, and it had soft forward-looking growth numbers. Now that in the latest number in April came through positively. So we've got Japan, it's an early signal, but ultimately coming out of that very bearish territory of the bottom right into the top right, which is you can get good quality equity returns on a forward-looking basis. Comes out of that top right quadrant. So I'll just note that China obviously very strong, and that US number on developed markets, US is now looking on this analysis the poorest of the lot. So if I go to the next slide, India maybe is the only other one that is of interest that people have been talking about, which is also finds itself in that top left quadrant. So relatively strong for India. Next slide. We're talking about relativeness of countries in those previous slides. The same analysis we apply within an asset an economy. If you look at the the different styles of equity portfolios and what economic regimes they tend to do well in or poorly. So here I've just mapped like the best three, which are in the green, styles that you might be looking for, to the extent that you're confident you've identified you're in the top left quadrant. You want to be positioning your equity portfolios for momentum, taking small cap positions, so size premium tends to do well, and growth in that sort of top left. And on a relative basis, you want to be avoiding sort of yield plays, tend to be the relative underperformers in that scenario. So if we think about, we've got Europe, we've got China, we've got Australian market, all in this top left quadrant. These are the relative styles our model suggests we're thinking about when we're constructing the portfolios, where we'd be in talking to your managers, understanding what their dynamics look like. This is where our preferences would be tilting. And then similarly, if we've got the US market leaving that top left and heading down towards into the bottom left, that's where more quality and low vol and surprisingly value on a, you might get an initial reaction on value, but on a 12-month outlook does tend to do relatively poorly. Value tends to do more well on the right-hand side there, so the bottom right, when you've also got inflation pronounced in the market. I know there's inflation fears in markets for the longer end, but the on-the-ground inflation numbers are certainly not in play at the moment. So there's the sort of things we think about. To the extent that you're looking at Japan, it's going. You would, if you're in Japan, you want it to be in low vol when it was in this bottom right quadrant, but there's momentum and quality. Low vol actually does very poorly in the top right quadrant on a forward-looking basis. So these are the sort of things that we tend to look at in more the sort of manager and security selection decisions underneath the hood. Next slide. So I've just had Damien has some slides, so I'm not going to harp on about this, but effectively you see through this is through to sort of the middle of May. We've had this big correction, and then you've had the retracements that have occurred. International equity markets generally it's still a little bit below where they were, but there's been that big retracement, and it leads me to the next slide, where I've got what I thought I'd look at was realized vol in actual portfolios. So if we take like a 70% balanced or growth portfolio, depending on the label you use, there was certainly this peak. People were talking about VIX, which is this sort of market correction. You get a fear signal, or and VIX, if you understand how that's around option pricing and the like. But the realized vol clients would have seen is their 70% growth portfolio or whatever it might have been had a drawdown. So that's on the bottom right here, where you see the typical experience of portfolios mid-month through April. There was then, as through May, a lot of that sort of downside has been retraced now. But on the left-hand side, I've plotted this a 30-day rolling volatility. So when we look at volatility, we tend to think about in a sort of top-down asset allocation decisions. We tend to talk about volatilities on a per annum basis, and having a volatility of 7 for a balanced portfolio, 7% per annum. So that's looking at what's the variance you'd expect on a portfolio if it has a mean expected return of, say, 8% with a vol of 7, then you're really talking about having a return over a 12-month period in the range of 1 to 15, being that mean return plus or minus 1 standard deviation. But in a market correction, everyone tends to look at VIX and these short-term measures, and really I guess the behavioral thing around volatility is particular in these market corrections is you get this spike of volatility, which is now retraced. So I'm just wanted to point to there's been a correction, but if the vol has also come down. So if you look at where those daily moves were in sort of the first half of April, where we had these wild market moves when you'd wake up and see where the US market was and it had moved materially. We've then had that retracement. The retracement, has been relatively benign in terms of volatility. So that's meant that initial surge of volatility has gone away. But so it's just just be conscious around volatility and maybe, I don't know if the term risk means different things to different people. There's many different ways to measure it. Are you talking about achieving your objectives as a retiree, which tends to be more about longer term risks and what they look like, measured in potentially years, and what the volatility of that outcome looks like is quite a different thing to looking at short-term portfolio volatility that comes in spikes, the likes that we've seen here. Okay, so next chart. So here I've just plotted. So the three of us separately go away and come up with our thoughts about relative tilts, attractiveness or not of the relevant asset classes, and this is sort of where we individually are at the moment. So effectively, there's similarity across a number of them. There's a few deviations. I think fair to say Giselle's more materially underweight on the duration side, and maybe the different position around real assets and alternatives between myself and Damien and Giselle. They're probably three more material changes, but we can dig into those as we have the conversation. And then the next slide, what we do is we sort of aggregate. So the green slide is the aggregation of our views, and I've contrasted that with the blue, which is where we were positioned when we met in March. So that's I'll leave it there. Thank you, James.
You're on mute.
Thank you, Kev. And I would now like to turn to our independent investment expert, Giselle Roux, who's been in the investment markets for more than 30 years. Her financial career commenced as an equity analyst with Merrill Lynch and then Citigroup. And Giselle was Chief Investment Officer at JB Were and held a similar position at Escala Partners. Since leaving Escala in late 2019, Giselle has worked with a small number of investment groups and related organisations on aspects of financial markets, and she participates in many investment forums such as this. So, Giselle, I know you have a few questions burning a hole in your pocket, so you have the virtual floor.
Thank you, and thank you for those presentations. But both of you, we're all addressing this question about volatility and uncertainty, and I know that the client base is perhaps jumping at shadows all the time because they're such reactive markets. Have we learnt anything from correlations and relative performance in asset classes during such events that should impact on our asset allocation and portfolio construction?
I might have a go, Damien.
Yep.
Because I got a live one at the moment where we've had a group come to us that I guess has been surprised with their downside experience in the last 2 months, and so we've run an analysis of their portfolio, and we did a sort of top-down asset allocation piece of work, and that came out with an expected sort of return profile and risk profile, and then we looked at the actual experience of the portfolio, and it was vastly different. And so on a bottom up, when we aggregated the portfolio, they'd effectively thought they had more diversification than they had. They were making ETF selections or manager level construction decisions that was putting tracking error and more beta into the portfolio. And so things like and it wasn't just in equity markets, it was in their credit exposures, for example. They were running more risk than they probably thought they were. And so I guess calibrating, making sure you do your work from your asset allocation, but also it's important with your bottom-up construction that you're not putting in more risk than you're expecting you have from your construction of your portfolio.
Okay.
Yeah. I'll just add, I think probably the one area, maybe this is what you're really asking, is bonds and the role of bonds maybe in portfolios. And I think in the last 2 to 3 years, we've seen the diversification benefits of bonds being questioned in portfolios. Certainly in 22, they were well and truly. And I think it's coming to light again, as events that we've seen in the last 2 to 3 months. Bonds are, in the downshift in markets that we saw in April, yields actually rose. So why? And is it something that's structural? Well, our take on it is that in the world we're in now, it's more inflation prone than it has been for a long time. It's more, there's more, I suppose, geopolitical risks that we need to take into account. And given those two factors, then bonds may not always provide you the diversification that you look for. When I say bonds, I mean long duration. And that's really why I think when you see, the committee having a sort of an underweight bond position is broadly right. And probably also from an SAA point of view, you've got to question the role of bonds. So bonds will do well in recessions, but they won't do well in inflation spikes. And so you've got to look at other assets, and that really speaks to probably why the view of the committee is also to have more in assets like infrastructure, which tends to provide a little bit of an offset, so real assets to those inflation spikes.
Yeah.
I guess there's no way of avoiding volatility per se, but I thought your point, Kevin, is that it's the old story of somebody goes on holiday for 6 months and comes back and says nothing's changed, and you look at them and you've aged about 10 years in 6 months. Yes. I think that's happened to us all.
And maybe there's the old adage around portfolio rebalancing is key, right? Where
we probably didn't do that for a long time.
And so and there's an opportunity in did some work for an industry fund, and their mindset around alternatives was, well, can I find fine. Ideally, I want to have assets that are going to give me diversification away from equities, but maybe there's also they had this other component of their liquid alternatives, which was around can I find things that just price differently to equity markets that I've got a good confidence I'm going to be able to sell, and they would use it tactically where they'd try to in market corrections use it as a liquidity pool to then go back into equity beta. So whether you do it just structurally with a rebalancing tool, or do you use your alternatives as a liquidity pool to then use that to fund going back into equities.
Well, so that just one question further on equity, or one question on equities, because we tend to talk perhaps too much about equities, and it's worth talking about the other asset classes. But if on equities, one thing that strikes me is, this old, I hate the word, de-equitization. We've seen the number of companies listed on markets drop. We see higher concentrated markets, therefore narrower market performance. So just in a broad sense, does it still make sense to have 60% listed equities when their performance tends to be the same in periods of strife? And that brings up the second question is, what do you think about, what kind of mix of equities would you recommend in the current environment, particularly yours, Jamien's, where you're talking about those more volatile periods in the future, recognizing what Kev says at the moment, there's not a lot of volatility, but in long-term volatility, uncertain markets, what kind of equities and what weight in equities, if equities aren't weighted the same, aren't structured the same as what they were?
Yeah, so I think in when we're looking at portfolios, I mean, a lot of the, and most of the people listening in, they're probably constrained a little bit when they're building growth and defensive portfolios. They sort of feel they've got to have 60% in growth assets. So it's how you allocate that growth piece. So depending on how you define asset classes, you might include in that 60%, different parts of the equity market. And we've already talked about infrastructure as being a real asset, property to some extent, which has been knocked about pretty hard over the last few years. This is listed property, global listed property. These are some of the areas that I think that are probably at a different stage in the cycle compared to the equity market. So there's the possibility of diversification there. But you can get some equity-like risk in the bond market, in your defensive part of the portfolio, right? So you should think of assets as a continuum rather than this is growth and this is defensive. So I think that's the way we have to think about markets now. And so what that means is you might carry credit, but what sort of credit are you going to carry? You probably don't want credit with a lot of bond duration. You probably want floating rate credit, and I think that's what the committee has talked about in the past. So there's other ways. Just move away from some of the arbitrary asset class classifications.
We've got a couple of questions coming in from attendees. This one from Scott Marshall. If the average negotiated tariff settles at 10 to 15%, is that enough to encourage companies to move to the US, or is this all just a revenue-raising exercise for the US budget?
So 10 to 15 will give the US government about $250 billion, right? $250 billion, which sounds like a lot of money, but it pales into insignificance when you think of the size of the US budget. So it's a small revenue raising exercise at that level. So that's that part of the question. The other part is it enough to encourage companies to move to the US? I thought it was instructive a week or two ago when the Trump administration criticized Apple for relocating its production out of India. Why shouldn't they be moving to the US? And of course, the reason they're not moving to the US is it's really expensive. And unless consumers want to pay $3,000 or $5,000 for an iPhone, they're not going to move production to the US. So it's going to be really difficult. Yes, there'll be at the margin some companies relocate, some companies make investment into the US, but I don't know if it's enough to move the dial.
Thanks, Damien. Back to you, Giselle.
Well, I think that's both those, the question from the floor and comments, bring up this question about what outside of equities, what should our portfolio construction look like? So we generally, and as you can see on the dot points, I'm very anti-duration simply because I think it's unpredictable duration at the moment. So it comes down to how do we actually construct floating rate portfolios, and as importantly to our overweight on real assets, how do we look at those with regard to both inflation and yield sensitivity?
Do you want me to take that, Kev? I'll take the second part of that.
I mean, just my only real comment is, we we often spend a lot of time looking at Sharpe ratios and Sortino ratios, so risk-adjusted return. So what's the trade-off? And duration has been very expensive portfolio protection, if you like. You've paid for, you've got a relatively modest return relative to floating rate, and you've got all this volatility that's come on your portfolio from that interest rate sensitivity. So there's the long end of the curve is moving around wildly. When you've got a long duration, it's a multiplier effect on your valuation of your bond portfolio. So that volatility at the long end has dissipated the sort of portfolio protection characteristics. So but then you need to be, so when you move away though from that traditional bond ballast, if you like, to your portfolio, you got to be careful. You don't just end up with equities plus credit risk in your portfolio. So we've, as a committee, we've talked about this to say, we've tilted into defensive, asset-rich property and infrastructure, which has some interest rate, some inflation protection within the revenues. Credit, don't be careful about how far down the credit spectrum you go, and you understand the credits that you're actually investing in, what those structures are. So I think, and then obviously you got your cash as your reserves as well. And as I said, the alternatives, it depends how you can structure them. The ability, I think you touched on earlier, is around private markets. There's plenty we can say about that in your portfolio construction. Depends on who the investor is and their ability to execute in that space. But that's another mechanism for a smoother outcome for investors, albeit it's because it's not very valued.
Yeah. Damien, I think, because to remind, I think everybody listening, that we use only listed assets. So in infrastructure real assets, you have to look at the listed market. And how do you actually look at those with regard to correlation and that they are equity-like in characteristics simply because they trade as equities? Or do we need to look through the way they trade as equities? And if people have the option to go to unlisted, would you recommend that in preference?
Yes, if they do have the option to be unlisted, yes. I think global infrastructure is an attractive asset class in this environment, and so you talked about the inflation protection. I think that is there. It's fairly clear. Yes, they have interest rate sensitivity, but interest rates are already back to what we would say is pretty normal levels, or much closer to normal levels. So that risk may have dissipated. So I think they have a place, definitely, both unlisted and also in the listed market. I think there's still, certainly globally anyway, a slightly more diverse portfolio exposure. I mentioned REITs before. That's an area that's become a little bit more interesting in recent times. Valuations have improved a lot. The economic outlook, as long as there's no recession, which, as I said, I don't believe there will be, that you'll get continued growth. So we think those two parts of the market actually look okay. Yes, they are equity-like, and in an equity market drawdown, they will get hit. Yes, of course they will, but we think they're relatively well positioned.
And what about hedging, Damien? You mentioned the US dollar.
Yep.
Would you encourage people to hedge more? And thinking about the cost of hedging these days is been expensive in the last couple of years.
Yeah, so you want to be fairly clear in what you're hoping to achieve when it comes to hedging. So, in a typical balanced portfolio, you will have, we would suggest 70% would be unhedged of the overseas exposure. Right now, we would be sitting at sort of 50 to 60. So having a bit of a hedge in place, and that view is really a Aussie US dollar view, that Aussie dollar in the low 60s is probably 10% cheap, 10 to 12% cheap versus the US dollar. But the US dollar is expensive against everything, let's face it. So the chart I showed earlier on, you showed that. We expect the US dollar to have a weakness in the period ahead. over the next few years. So, yeah, that should get the Aussie dollar eventually up into the high 60s. So we think it's worth doing, even though the cost of hedging is a little bit higher.
The only maybe thing I might say on that is, particularly when we're positioning portfolios with less of that duration ballast in the portfolio, then we'll lean more on unhedged equity exposure, just given, you know, whilst we might have a view about the short-term valuation of AUD, USD, or the other pairs, in a risk-off scenario, the Australian dollar tends to fall against the safer currencies, and so it becomes itself a bit of a defensive ballast in those risk-off scenarios. So.
Yeah, can I just add that's a really interesting area, though, I think, Giselle, because I think we saw in April the situation where equity markets were drawing down heavily, yet the Aussie dollar was rising, the US dollar was weakening. So this is highly unusual. So I agree with Kev's comment, unless the reason for the drawdown is US economy, US credibility related. And that's the issue that we have to be a little bit, we shouldn't just not assume always that the Aussie dollar will come to your rescue, I think is probably a key.
And of course, it depends on how you construct your equity portfolio. If you've decided to take European, Japanese, you need to think hedging distinctive to those. We're very centric US dollar cross rather than the global cross. Yep.
And we have a question here from Gabrielle, an attendee, which I think will also serve to act as a kind of a natural summation for everybody. Given the recent rise in bond yields and the uncertainty surrounding the potential fiscal policy direction under Trump, how has that influenced your market outlook or investment positioning?
I'll just really quick comment. I mentioned a bit of an underweight to bonds, underweight to duration. Yes, good there, good in the case of recession, so you need to have a bit, but don't rely on it under all circumstances. So that in replacing the bond position, we would look to other assets, and we've already talked about some real assets. We've also talked about low duration, so floating rate corporate credit, high grade corporate credit is the way we tackle that.
And the only other thing, I mean, you saw our chart where we've got it going from the top left to the bottom left. So, you know, the current signals are weakening for the US. But to caveat that with, you know, one thing we're keeping an eye on, we've got this idea around coming out of the GFC, you know, markets for a long time were driven by central bank activity, you know, all the way down to zero and negative rates and the like. But the thematic at the moment is more around fiscal than monetary, and sort of what governments are doing is having more of an impact on markets, whereas previously, you know, central bank activity was the myopic sort of focus of markets. And so, you know, we'd expect, I take Damien's point around Trump and his willingness to take some pain to get his tariffs through, but I would sense that over, you know, what he'll want ultimately for his legacy over the 4-year span of being in power, you know, he's going to become more accommodating and be conscious of where the S&P is, right? So, you know, ultimately that fiscal driver, you know, we'd expect that will come through, you know, with more accommodative tax reform and you know, the takeover opportunities that, you know, it all dried up in US markets under the previous administration, you know, being more positive for that market environment. So.
Thank you to all of those questions from both Giselle and our attendees. It's time now as a committee to come to a decision on the tactical asset allocation for the next quarter. As shown by the chart on the screen, all committee members have made asset allocation suggestions. And on the basis of these, Kev has prepared the dot plot of tactical asset allocation nominated weightings and the aggregated view or the committee consensus of the TAA for the notional reference portfolio. So Do we want to modify that? Speak now or forever hold your peace? If not, as a final decision, the committee has concluded that this will be the ongoing tactical asset allocation for the notional reference portfolio with, and not surprisingly from a lot of the commentary today, that long duration just not quite there at the moment, and more of a bent towards floating rate and international shares. So any final comments from anybody?
Good.
No, good man.
Okay, well, to close things out, I just wanted to summarise what there's been a lot of information imparted today and a lot of things discussed, but just a few takeaways. That the US exceptionalism story is threatened, and valuations do look stretched, but US equities can still be core, and also that the US, the likelihood of recession is becoming less likely, although the growth rate and the inflation rate expectations do have to be tempered. I thought another interesting takeaway was that inflation and globally and geopolitical situations and uncertainty are affecting correlations in the short term, and there needs to be a rethink on that. And Damien, I think you were strong on the fact that bonds might not give you what you're expecting in the short term, but if you look at other areas like real assets and floating rate, they can fulfill some of that role that people were perhaps expecting bonds to play. And also, and I think green shoots in the Australian economy and Japan, after initial disappointment, moving back into some form of a positive view, they were also interesting takeaways. So thanks to everybody for their contributions today. It's been a very productive very productive session. I was watching Succession last night, so I had a Freudian slip on that. Today marks the 5th meeting in which the Brilliant Investment Committee has analysed the economic and markets backdrop and, if necessary, tweaked the notional reference portfolio asset allocation. There is one continuing professional development point available for participating in this session. The survey that we'll be sending to you shortly must be completed to receive this. But thank you all again for your attendance and participation, especially members of our insiders community, for watching and engaging in the session. And we'll be back, the Brilliant Investment Committee, a date to be set, but roughly 3 months' time, for another quarterly look at our asset allocation of our notional reference portfolio. Thank you, one and all. Thanks for giving up your time. Thank you, Damien, Kev, and Giselle in particular, and everybody else. Have a great rest of your Thursday.
Thank you.
Thank you.